So nobody has ever been able to give me an answer to this question, right? I've been doing this. I've been in this business for about 20 years. So the question that I asked somebody, I said, "Hey, look, if you find me a place or a strategy, right, that's better than this, life insurance that I kind of talk about with people, let me know and I'll stop selling this, right? I'll stop doing this, whatever I'm doing right now, you know." And nobody has ever been able to answer that for me. So I've been in this business for like 20 plus years. My background is in real estate. I was investing in real estate, and then I discovered this, and then I started implementing this, and I'm like, well, I like this so much. I want to teach this to everybody, right? So that's kind of like how I got into this rabbit hole. But I see a lot of debates right now. I see it with people about ROI. I see it with like cash value, and then I'll see it with like how much do you make commission wise. So I'll address those three, right? I'll address those three right now. So let's start maybe with like the actual policy itself, like the structure. These policies are designed. I would say they're designed, the way I would explain it to people is like I'll tell them like it's designed the opposite way, meaning nobody really comes to me. Well, now I get this now to where they're coming for me for life insurance, but majority of my clients are investors, and they're always coming to me like, hey, can you tell me more about this cash value life policy? What is this? How is this designed? I'm hearing a lot about it. There's a lot of noise online, right? So let's answer that question first. The design is almost like the opposite design, right? It's flip, meaning when you come to somebody and you say, hey, I want $1 million death benefit, then they're going to inject everything, right? They're going to say, hey, this is how much premium you have to put to get to that $1 million. The other question is usually the one that I get. It's like, hey, how can we design it to where we're injecting the majority of it into the cash value and buying the least amount of death benefit? That's usually the baseline, the foundation of the design. So it's flipped, okay? Now there's infinite design. So depending, like I said, it's not just a one size fit all. It depends on what your needs are, what your goals are. Some people will say to me, it's like, Joe, I want protection. I want more death benefit. Then we'll play around with the math. That's usually how it's designed. Now, to all the agents out there or people that are asking about commissions, we actually make a lot less because we're designing it the opposite way, right? So whoever, because the commission is based on the death benefit. It's not based on the cash value, right? The cash value, we don't get really anything for that, right? It's mainly like, hey, how much death benefit are you getting? So that should answer the question. It's a flip. So most agents that are designing it this way, you're cutting your commission to a third, maybe even less, right? Depending on what company you work for. So that's a commission question. The other question is the design as far as the how much cash value do you get like right away, right? My policy, I had about my first, because I'm like my about to do my third one right now. So mine was like it's between like 60 to like 80 to 90%, right? That's usually the design depending on risk factors, your age, all that stuff, what company you're kind of going with. But mine was I had 70% access right away, you know? So like for example, it would be for an easy math, my year one, I have let's make it simple, $10,000. So I had access to seven, right? Like right away, the first week, as soon as it's issued, boom, I had access to that. I used that right away, right? For whatever I need to use it for, if needed, okay? So that's usually how it works. So you have access to between 50 to about 90%, depending on how the policy is designed. There's also other factors, company, age, all that stuff, right? So that's usually where it sits. And again, depending on the goals, depending on the client. So normally cost basis, meaning you have access to every dollar you put in. That usually happens what age? Between 5 to 7 years, sometimes 10 years, depending on your age, your health, all that stuff, right? Between 5 to 10 years, when you have cost basis, meaning every dollar you put in, you already have access, and then from there, it's just gonna be like, it's just gonna grow, right? Now let's get to the ROI let's get to the ROI argument, because I get this all the time. What is the ROI? Now, I always tell people, going back to the first question that I had, if you can find me a better place to do this, like as far as ROI, I'll even argue the ROI part, right? Because this is not an investment, guys. This is a strategy. That's the main thing. Because if you're looking at it apples to apples, then you're just gonna be disappointed, right? You're gonna be disappointed because the ROI is probably like within. Now that also depends, right? Because it's a massive death benefit attached to it. So if you get this and then something happens to you, then the ROI will be a lot. The best ROI is if you get the policy and you die the next day, you get run over. That's the best ROI, because you're getting all the death benefit and you only put like one premium, right? Now, if you're looking at this long term, let's say you live till you're 80, 90 years old, the ROI is probably, if you're just looking at the product, the ROI is probably like around 3-4%, right? That's probably going to be the ROI. But here's the big but, okay? It goes back to, this is a strategy. The investment aspect happens outside the policy. The policy for me is just a peace of mind, meaning I sleep good at night. If something happens to me, something happens to my family, I have that death benefit covering them, right? When you get older, there's also a long-term aspect to this, to where long-term care aspect, to where you have access to the death benefit, right? It pays out, so you can use it while you're still alive. That's a peace of mind. I sleep good at night. What's the ROI on that? Like, let's say, for a lot of the investors out there, like maybe like real estate investors, or you in the crypto space, in the stock market, let's say there's a deal, right? That happens. Your money, let's say you have 100,000, because I've done this before, 100,000 sitting in the policy. There's a deal over there, real estate deal. I pull 50,000 out, use it for that deal, okay? My 100,000 inside is still making money. And then I made 12% over here, 20%, 30% over here with my real estate deal. What's the ROI on that? Okay, so this is the strategy that comes with it, right? You can it's not just for you can use this for anything, right? So here's another perfect example. 2020 happened. Market dipped, 50%. Okay? My mentor took $300,000 from his policy. Let's make the math simple. Let's say he has $1 million sitting in his cash value, making 5%. He pulls 300,000 out, puts it into the market. That 300,000 in 1 year that's a 4x, right? With oil and gas, he makes 1.2 million on that 300,000. Pulls the 300,000 out, puts it back in his policy. The whole time, his 1 million is still making 5%, and his 300,000 outside made 900,000. Okay, so his 300 turned into 1.2, and then he pulled the foundation out. He pulled the 300,000 out, puts it back in his policy, pays policy loan, let the rest ride right in the market. What's the ROI on that? Okay. So if you're looking at cash, like paying cash for something, because a lot of times what happens with investors is you have your let's say you have $500,000 sitting in your account, right? Earning less than 1% in your checking account. Every time you drain that tank, every time you use 300,000 of that 500 to pull, that 300 is no longer working for you. It's already out there, right? Or even if you spend it for whatever reason, if you buy a car, that's already out there doing, somebody else is already making money in that money. The idea is an interest arbitrage play. You're making your money do multiple things at the same time. So you're making your dollar do multiple things, right? So meaning your dollar now is doing the protection for you. Your dollar is doing the meaning the protection as far as like death benefit. If something happens to you, you sleep good at night. You rest well knowing that if something happens, your family is going to be taken care of, right? Your wife, your kids, whatever, or your opposite way, okay? You're also peace of mind to where now the dollar is doing the long-term care for you. Now the dollar is doing the real estate investing for you. Now the dollar is doing the crypto. Now the dollar is doing the stock investing, right? now is doing all of these things for you. That $1 is doing multiple things at the same time, meaning you're creating this process to where you're streamlining it, right? You're running more efficient with your money. That's really where the magic of this, because it's the uninterrupted compound interest curve that, it's so simple, guys. It's like, it's counterintuitive, right? Your money is always going to be in there. You're not using your money. So this is another thing that people seem to not understand. You're not using your money. You're using OPM, other people's money. You're basically borrowing at the same or at a lower rate. Okay? So the strategy is you're borrowing at the same or at a lower rate, and then your money inside is never interrupted. It's just going to grow, right? That's really where the magic happens, because at the end of the day, again, like if you're just comparing this to, like, if you're putting a life insurance product here and then the stock market S&P, you put your money here, you're never going to beat that, right? Because to me 3 to 5% return, that's nothing, right? It's what you do with that money is really the investment aspect. The money is just there for peace of mind. It's stored in there. It's kind of like putting it as a private reserve account. That's how I see it. It's a private reserve account. Money is sitting in there, is doing all these things for you, right? And then later on, this is where people miss. At the end of the day, it's still a life insurance product, right? To me, the death benefit is the most important part, because I can liquidate, right? I can liquidate my real estate holdings. I can do everything I can do later on and still have something to give to my kids later on, right? So I hope that made sense. Again, if you have any questions, reach out. But that really is the whole concept that people don't seem to understand, is it is not an investment. It's a strategy, right? What you do with the money outside is the investment aspect. And then obviously, like, to me, the death benefit is probably the most important part. Now, I used to not think this way, but the more I talk to like older people, like when you get to like your 50s, your 60s, you're like, God dang it, I should have started this, years ago, because at this time you can actually use it as an income source, as a cash flow source, because there's no other place on the planet where you can literally put $10,000, it turns into like 30 by just writing a check. That doesn't happen anywhere, right? You can't do that to your checking account. You can't do that anywhere on the planet, where you write a check and it just like does a 2x, a 3x, depending on how long you've been putting money into the policy, right? Meaning you've injected time and compound interest already into this process. So if you have any questions on this, reach out. I'll be happy to answer it. But that really is the main thing. People are looking at this from a different lens, right? And I've never had anybody like, if I ask somebody like, look, find me a better strategy, I'll do it. Because you can do this with anything. I use this with crypto all the time. I've used it with the stock market. I use it to pay debt, right? Because you're just basically playing the bank game now. Now you are now the bank. So you almost have like two brain, right? You have Brain right here, Joe Brain, and then Joe Brain, the president of his own family bank, right? So now this Brain right here is saying, hey, if I'm gonna borrow money from this policy at the same or at a lower rate, is this money gonna make money? And if the answer is no, then you deny it, right? If the answer is yes, then you approve it. So that really what it comes down to. You have to kind of play that game. And it's not for everybody. So there's people that are going to be horrible at this. And if that's the case, then I wouldn't even suggest this for you. It's better just get term invest the difference, right? Like Dave Ramsey said. Term invest the difference, do that. But if you have a lot of liquidity, or you're saving at least $6,000 or so a year, then this might be something that you want to look into. But other than that, if you can't even save, if you're not a good saver, it's not for you. You have other problems that you need to fix first before even implementing this, right? So questions, let me know. Hope that helped, guys. Take care.